So good evening, everybody, and welcome back to this session on financial management for CMA intermediate students. In the last session, we actually discussed about dividend policy decision chapter. And last time when I asked you that what chapter would you like to study in the next one, and you recommended that we will be studying capital structure theories. Hence, accordingly, I plan today's lecture to be on capital structure theories. Now, what does this chapter actually says us? Just a second. Okay, so here we go. One of the chapters you have already studied is cost of capital and capital structure decisions. If you try to recall it, there are three major factors which affect your capital structure decision. First factor is financial risk. Second factor is control. And third factor is cost. Let me remind you what is capital structure. Say I am an entrepreneur, I have decided to start a business, and that business requires investment of 1 crore rupees. Now the question arises, what are the various sources of finance which I should use for raising this 1 crore rupees of fund? So I can use entire amount by issuing equity shares, I can raise entire amount by preference shares, or by debentures, or a term loan from the bank, or project finance from the public financial institution, or there are many other sources of finance which are actually available. So I usually don't prefer a single source of finance. Rather than I make a mixture of various sources of finance, and that mix of various sources of finance is actually named as capital structure. So while designing capital structure, there are two things which you should keep in mind. Three things. First thing is financial risk. You know, if you have more amount of debt in your capital structure, in that case, your financial risk will rise and you should keep it within control. You should keep it within limits. It should not rise too much. So too much of the debt is not preferable. In fact, from risk point of view, you should try to raise more and more amount by issuing equity shares. And that way you can keep your financial risk within the limit. But the other thing which you need to consider is control. If you issue too many equity shares, then these new people will also have the right to vote. They will become the partner in decision making in the company, and that can influence your long-term plans. So from the point of view of control, actually debt is the best source because debenture holders do not have the right to vote. So if I raise some amount by issuing equity and some amount by issuing debt, that way my control and risk both will be balanced. But now the third most important thing is actually cost of capital. So while raising fund, your concern as a businessman is that the fund should be raised from the sources so that your cost of capital is as low as possible. You would not like to raise fund from the sources which are very expensive. You would like your cost of capital to be on the lower side. So now capital structure theories topic is discussing this particular fact only, that does it really affect the cost of capital if I change my capital structure? If I change capital structure, does it affect my cost of capital or not? So various experts have various opinion on this matter. In fact, there are two schools of thoughts. There are some people who say that if you change the proportion of debt and equity in your capital structure, then your overall cost of capital will also change. There is a second school of thought which says that even if you change capital structure, that is the proportion of debt and equity, your weighted average cost of capital, overall cost of capital will remain same. In total, there are four approaches. As you can see on the screen, the first approach is net income approach, NI. Second approach is net operating income approach, that is NOI. Third approach is Modiglani and Miller approach, that is M and M. And fourth approach is traditional approach. So one by one, let's discuss all these approaches. So let's begin with the first, net income approach. Look here on the screen. According to NI approach, value of a firm and definitely its overall cost of capital also, because value is equal to performance divided by cost of capital. Value is equal to performance divided by expectation. So if overall cost of capital or expectation changes, then value will also change. According to NI approach, value of a firm is dependent upon its capital structure. So NI approach says that if you change the proportion of debt and equity, then usually debt is cheaper, equity is expensive. If you increase proportion of debt in your capital structure, then you are increasing the proportion of cheaper source of finance. So that way your overall cost of capital will reduce and wealth of the company will actually increase. This is net income approach. And it sounds good also. Suppose I'll take an off-bid example or below level example so that you can have a proper understanding of the concept. Say I am manufacturing one sweet which is named as Kaju Katli. Okay, so there are two major ingredients. One is the cashew nut or kaju and second is sugar. Now cashew nut is quite expensive. It may be 1,000 rupees per kilogram or at least 600-800 rupees per kilogram even if the quality is lower. And comparatively sugar is very cheaper, say 50 rupees, 60 rupees per kilogram. So there are two sources, there are two ingredients in the sweet I'm preparing, in the dessert I'm preparing. One is the cashew nut, that is kaju, and second is sugar. And one is very expensive, the other one is very cheaper. If I try to make it more sweeter, zyada meethi mithai agar main banane lagu, and if I increase the proportion of sugar in that Kaju Katli sweet, then definitely my overall cost of manufacturing, producing, making that sweet, that Kaju Katli will reduce because I'm increasing proportion of cheaper material and that way my cost should actually reduce. Similarly here, equity is an expensive source, debt is comparatively cheaper source. And that's why if you increase proportion of debt, then your overall cost of capital will actually reduce. Okay, I'm asking you one question. Why is it so that equity is cheaper? Equity is expensive and debt is cheaper. Just think about it. And if you come up with the answer, then post your answer over here. Why equity is expensive and debt is cheaper? You have to answer that. Now on the screen, you can see one diagram. In that diagram, okay, I'll make one change in this diagram. I'll delete some of the items. 1, 2, 3. Now this diagram is comparatively cleaner. On x-axis, this is the graph. On x-axis, I put debt to equity ratio. On y-axis, I put cost of capital. Now, there are certain assumptions under the net income approach. The first assumption is cost of debt remains constant with increase in debt equity ratio. So if you are borrowing 1 lakh rupees, say that is available at 10% interest. If you borrow 5 lakh, 10 lakh, 50 lakh rupees, that will also be available at 10%. If you are borrowing 1 crore, 2 crore, 5 crore, 10 crore, 100 crore, that is also available at 10%. With increase in amount of debt, your cost of debt will not change. It will remain same, right? I can see there are many attendees for this session, but still I'm not getting the answer of the question I have asked you. Why is it so that cost of equity is usually more than the cost of debt? Why? Why at all? I'm waiting for your answer. So in this graph, on x-axis, I put debt equity ratio. On y-axis, I put cost of capital. And first assumption says that cost of debt, this cost of debt will remain constant with increase in debt equity ratio. And it is also assuming that the cost of equity will also remain constant with increase in debt equity ratio. So even if you increase proportion of debt in your capital structure, your KD will remain constant and your KE will also remain constant. Now there is a third assumption also. Okay, meanwhile I got one answer. Shivam is saying, sir, maybe because of ownership, control and flotation cost. Absolutely right, Shivam. Ownership you have, that's why you will charge more rate. Okay, Shivam, you are right, but I'll tell you one more reason behind it. If you are an equity shareholder in the company, at the time of liquidation, you are the last to receive the amount. So if the company is in financial trouble, you are the first to bear that financial trouble or loss. So you bear very high risk as compared to debenture holders. In case of liquidation, they will be before, they will be standing in the queue before equity shareholders. First they will receive amount and then equity shareholder will receive amount. And you know, debentures may be secured also against the mortgage of some of the securities. So being an equity shareholder, you bear too much of the risk, and that's why you demand higher return, and that's why your cost of equity is higher. Anonymous is saying because equity is expensive. No, that's not the reason, sir. Sachin Mishra is saying the cost of debt is finite and the company will have not any further obligation to lender once the loan is fully repaid. Sachin, you are partially right, but there may be perpetual debt also. In that case also, the rate of interest on perpetual debt will be much lower than the cost of equity of the company. And as I told you, the reason is very simple. And the reason is like this: equity shareholders bear the risk, and that's why their expectations are higher. So first assumption is cost of debt is constant. Second assumption is cost of equity is constant. And third assumption of NI approach. Whatever I highlight on the screen, you should also try to read that. KD is less than KE. Look here, the KD is on the lower side, the KE is on the higher side. This is KD, this is KD, this is KE. And that's correct also. And fourth assumption is there is no income tax. So the proponent of this approach assumed that a company is not required to pay any income tax on its corporate income. Now, this assumption is rarely true in practical life. But anyways, this is one of the assumptions of the approach. In this case, you know, when you increase the debt equity ratio, means when you move towards the right on the graph on x-axis. In that case, the proportion of cheaper source will increase and proportion of expensive source will reduce, and see, therefore, the overall cost of capital keeps on reducing. Notice here that at y-axis, both KO, which is overall cost of capital, and KE, which is the cost of which is the cost of equity, both are equal. KO and KE are equal. Can you tell me the reason why KO and KE are equal initially? And thereafter, with increase in debt equity ratio, the cheaper source actually becomes dominant, and therefore overall cost of capital actually reduces. It is awesome OMSM class or FM class. This is the class for financial management, sir. Okay. So now you can see. So conclusion of NI approaches: with increase in debt, overall cost reduces. Therefore, wealth of the company actually increases. Let's solve one question on the same for a better understanding. Suppose capital employed is 2 lakh rupees. Cost of equity is 12.5%. Return on investment is 15%. That is on 2 lakh rupees. Company will be able to earn 15%. So 2 lakh into 15%. EBIT, earning before interest and tax, is 30,000. To raise this amount of 2 lakh rupees, company has got two choices, option 1 and option 2. Option 1 is you issue equity share of 1 lakh rupees and debenture also of 1 lakh rupees. At the same time, in option 2, you are issuing equity shares of 50,000 rupees and debentures of 1 lakh 50,000 rupees. So we are studying capital structure theories chapter, and the first approach is net income approach, which says that if you increase proportion of debt in capital structure, then overall cost of capital will reduce and wealth, that is value of the company, will increase. With this example, we'll try to prove the same. Look here, EBIT, earning before interest and tax, is 30,000 rupees. Now, whether you choose capital structure 1 with debt of 1 lakh rupees, or you choose capital structure number 2 with debt of 1 lakh 50,000 rupees, in both cases, EBIT is same. Okay, let me ask you one question. Is EBIT dependent on capital structure, or it is independent of capital structure? Dependent or independent? Come on, quick, answer it fast. EBIT is dependent on capital structure, or it is not dependent on capital structure? You know, probably you are getting this transmission 30 to 60 seconds delayed after I speak. And probably that is why I'm not getting prompt answers from your side. And probably even after your answering, you will feel like I'm repeating the question. Okay. So one Mr. Anonymous or Miss Anonymous is saying it is not dependent. Whosoever you are correct. EBIT is not dependent on capital structure. So EBIT is 30,000 in both cases. In first case, interest is 10,000 rupees. In second case, EBIT interest is 15,000 rupees. You know, it's quite simple. 1 lakh into 10% and 1 lakh 50,000 into 10%. So 30,000 minus 10,000 interest and 30,000 minus 15,000 interest. Now, usually EBIT minus interest gives you profit after tax. But net income approach assumes that there is no income tax. So profit before tax and profit after tax are one and same. There is no difference between the two. So, and you know, there are no preference shares in this question. So what is the way of calculation? EBIT less interest is profit before tax. Profit before tax less tax is profit after tax. Profit after tax less dividend on preference share gives you earning available to equity shareholders. But here in this case, there is no income tax. That is the assumption of NI approach. And also at the same time, there are no preference shares. So EBIT minus interest will directly give me earning available to equity shareholders. Now, if you try to recall, there is one formula which is cost of equity is equal to EPS divided by P. Or you can say that the price is equal to EPS divided by cost of equity. Or you can say this is for one share. EPS divided by cost of equity will give you market price for one share. But if you want to calculate it for all equity shares, then in place of EPS, you should put earning available to equity shareholders and divide it by cost of equity. So EAES divided by KE will give you market value of equity. Given in the question, cost of equity is 12.5%. Therefore, market value of equity is 1,60,000. See, you just check it. I hope you are carrying your calculator with you. 20,000 divided by 12.5%. Is it equal to 1,60,000? Just check it, please. And 15,000 divided by 12.5%, that will be equal to 1,20,000. This is market value of equity. If you have any doubt, just feel free to ask me. Then you should add market value of debt. So market value of equity plus market value of debt will give you total value of the firm, which is 2,60,000 and 2,70,000 respectively. So what you can observe over here, in option 2, there is more amount of debt, and that more amount of debt is favoring you. The value of the firm has gone up from 2,60,000 to 2,70,000 if you increase proportion of debt in your capital structure. So one moral of the story, with increase in debt, value of the company increases. Now let's calculate overall cost of capital. So usually to calculate overall cost of capital, you actually apply this formula. WSCC is equal to cost of debt multiplied by amount of debt plus cost of equity multiplied by amount of equity whole divided by debt plus equity. This is how you calculate weighted average. But today, for the purpose of this chapter, I am giving you another formula to calculate weighted average cost of capital. And this is EBIT divided by total value of the firm. So here I do it the same way. EBIT is 30,000 and value of firm is 2,60,000. And in other case, EBIT is 30,000 and value of firm is 2,70,000. I solve it. I get overall cost of capital equal to 11.54% and 11.11%. Somebody just posted, sir, please repeat. Look, whatever you post, I get it after, say, 50, 60, 70 seconds. So what do you want me to repeat? You need to specify it. All right, guys. So look here, overall weighted average cost of capital is 11.54% and 11.11%. Now, just a minute, please. You can actually cross-check this calculation by your regular formula also. Like here, if I make calculation of weighted average cost of capital, so cost of debt I'll put equal to 10%, and the amount of debt is 1 lakh. So instead of typing all zeros, I'll type 1 only. And cost of equity is 12.5%. And value of equity is 1.6 lakhs. This should be divided by 1 plus 1.6. So if I try to solve it, it should look like this. 12.5 into 1.6 is 20 plus 1, 30. 30 divided by 2.6. And that's 11.538%. So this is your regular formula, but with the shortcut formula, you are getting the same answer, 11.54% and 11.11%. Okay. Now I wish you solve one question on net income approach so that we can check that you got the concept. From the following selected data, determine the total market value and then overall cost of capital of companies ABC and XYZ Limited belonging to same equivalent risk class under the net income approach. Their EBIT is given, okay, and interest amount is given 75,000 and rate of interest is given as 15%. So if you divide interest amount by interest rate, like 75,000 divided by 15%, if you do, then you'll get the amount of debt, which will be 5 lakh rupees. Equity capitalization rate. Look, buddy, this is nothing but your cost of equity. This is 20%. So now you have to calculate value of firm as well as overall cost of capital under net income approach. So first step is EBIT less interest will give you EAES divided by KE will give you market value of equity plus debt will give you value of the firm. Then EBIT divided by value of the firm will give you weighted average cost of capital. These are the steps to solve the question. Now I wish you solve it now. So you have maximum 5 minutes of time and your time starts now. Once you calculate value or weighted average cost of capital, just post it in the chat box. I hope you are solving the question. So one of the answers is 33.09%. Okay. I think it should be on the lower side because cost of equity is 20%. So overall cost of capital should be less than the cost of equity. Overall cost for ABC is 19.67. I still doubt that this is correct or not. You are not able to hear me? Okay. Let me check. No, I must be audible. So I'll tell you. Look, PAT given in the question is 2,25,000. Amount of interest is also given. You just need to deduct it. Once you deduct it, you'll get earning available to equity shareholders. divided by cost of equity, which is 20%. To arrive at market value of equity, which is 7,50,000 and 11,25,000. Add value of debt to it, 5 lakh and nil. Total value of firm should be 12,50,000 and 11,25,000. So one anonymous answer is 18 and 20%. That sounds good. Hey, why don't you guys have your name also? So you are entered as anonymous, but when you post answer in the text form, you can write your name. WACC for ABC is 19.6 and XYZ is 20%. No, for XYZ this is correct, but for ABC you need to correct it. Look, the shortcut formula is EBIT divided by capital employed, EBIT divided by value. So EBIT is 2,25,000 divided by value in case of first company is 12,50,000 and value in case of second company is 11,25,000. So when you solve it, you'll get it equal to 18% and 20%. If you are not using this formula, and suppose you are using that regular formula of weighted average of KD and KE, then keep in mind you need to give weight of 7,50,000 and 5 lakh in case of ABC, that is the first company. Yes, Kiran, you are right. It is 18 and 20%. That's perfect. That's correct. Okay. Good enough. Now we have assumed that there is no income tax in case of net income approach. Later, this assumption of no income tax was dropped. That is, income tax is introduced in net income approach. Let's see what happens to net income approach if I introduce income tax. So the illustration I solved for you, I will solve it again, but this time with income tax at the rate of 30%. Okay, meanwhile, somebody is asking how value of debt is 5 lakh rupees, sir. Look, amount of interest is 75,000 rupees divided by rate of interest, which is 15%. So 75,000 rupees divided by 15% will give you 5 lakh rupees. Right? So the illustration we solved earlier, now I will solve it again for you, but this time with income tax at the rate of 30%. So look, EBIT is same, that is 30,000. This interest 10,000 and 15,000. But this time I am not getting earning available to equity shareholders. Rather than I am getting profit before tax. And that profit before tax is 20,000 and 15,000. Now I'll deduct tax at the rate of 30%. So 20,000 into 30% is 6,000. 15,000 into 30% is 4,500. Therefore, you know, when we were doing it without tax, earning available to equity shareholder was 20,000 and 15,000. But if I do it within tax, observe the change. Earning available is not 20,000, it is 12,000 for the first option. And it is not 15,000 for option 2, it is 10,500. Now I will divide earning available by cost of equity. In this example, not question number 1, I'm talking about the first illustration. It is 12.5%. So earning available divided by cost of equity will give you market value of equity. Just check it. Is it correct? 12,000 divided by 12.5% and 10,000 divided by 12.5%. Just check that. So without tax, market value of equity was 160 and 120. But here it is 96,000 and 84,000. I hope the calculation is correct. If any calculation has gone wrong, then just please intimate me. Now I'll add value of debt, which was 1 lakh and 1,50,000. Total value of the firm without tax, it was 260 and 270. So with increase in debt, value was increasing just by 10,000 rupees. With increase in debt, value was increasing just by 10,000 rupees, 2,60,000, 2,70,000. But with tax, when I'm solving it, value is increasing by how much? 38,000 rupees. What does it mean? कि टैक्स लगा करके तो ये अप्रोच ज्यादा अच्छे से प्रूव हो जाती है. Oh, English, yes. Moral of the story: with income tax, NOI approach is proved even in a better manner. Here the value was increasing just by 10,000 rupees due to increase in debt. Here the value is increasing by 38,000 rupees. So the conclusion is same. If you increase proportion of debt, value will rise and overall cost of capital will reduce. Earning available is wrong. Oh. Oh yes, it is wrong. Correct. So it should be 14,000 rupees. And then 14,000 should be divided by 12.5%. So that will become 1,12,000 plus value of debt is 1 lakh. This will be 2,12,000. So just a minute. Give me one moment. Earning available is wrong. I have corrected it. Okay, thank you, thank you. Wait a minute. And the second calculation, I hope that one is right. Now the shortcut formula will change. So the formula for KO was EBIT divided by capital employed, not capital employed. The formula was EBIT divided by value. And now the formula is EBIT multiplied by 1 minus tax rate divided by value. So EBIT here is 30,000. Tax rate is 30%. Tax rate is 30%. So it is 30,000 into 0.7 divided by value of firm 2,12,000. In second case, it is 30,000 into 0.7 divided by 2,34,000. So that way, overall cost of capital should be I'm not sure, but it should be 9.91 and 8.97%. Overall cost is reducing by approximately 1%. And when there was no tax, overall cost was reducing just by 40 basis point, 0.4%. And here it is reducing by 100 basis point, almost 1%. Right? So moral of the story, if you introduce income tax in net income approach, it is still perfect. That with increase in amount of debt, value of the firm increases and overall cost of capital reduces. Okay. So now it's your turn. Question solved. This time you assume income tax at the rate of 40%. Solution is in front of you. Use examples for clarity. So we are solving example only. What other example do you need? Okay, now you solve this question, A, B, C and XYZ limited question, but introduce tax at the rate of, what should I say? Introduce tax at the rate of 40% and solve this question. You have maximum 5 minutes of time. 14.21 and 20%. Okay, that sounds good. So this is profit before tax is same as before, but this time we have introduced income tax at the rate of 40%. So EAES is 90,000 and 1,35,000. Let's divide it by cost of equity of 20%. So market value of equity is 4,50,000 and 6,75,000. Value of debt may be considered as 5 lakh and nil. Total value of the firm is 950 and 675. So the shortcut formula for overall cost is EBIT multiplied by 1 minus tax rate divided by value of the firm. That is 14.21% and 20%. So without tax, overall cost was reducing from 20 to 18%. But with tax, overall cost of capital is reducing from 20 to 14.21%. And that's a big change. That's a huge change, in fact. In fact, I will show you one thing. Look here. This is your cost of debt without income tax. And this dotted line is cost of debt after income tax. So KD was comparatively higher, but after introduction of tax, cost of debt actually reduces. So earlier KO was reducing slowly, but now KD is further down. That's why KO is reducing rapidly. Overall cost of capital is reducing quite fast. So see the dotted line, and this dotted line is actually the new overall cost of capital after introducing income tax. Right? Okay. Great. Some people are getting 23% answer, which is wrong. 14.21 is correct. No, 19.8 is wrong. Correct answer is, I'll show you the correct solution once again. So this one is the correct solution. Just check it and identify where did you commit mistake. We have studied net income approach without income tax as well as net income approach with income tax. Now the next thing I'm thinking that rather than taking net operating income approach, I will first take Modigliani and Miller approach because many students find it to be difficult. And Modigliani and Miller approach, if I start NOI approach, then probably I won't have time for M&M later. So I will first take Modigliani and Miller approach and then come back to net operating income approach. What is Modigliani and Miller approach? Modigliani and Miller approach, named as M&M approach. Modigliani and Miller assumes that market value of a firm or its cost of capital is not dependent at all upon its capital structure. So the conclusion of M&M approach is just opposite to that of the net income approach. You know what does net income approach says? Meanwhile, there are some doubts. Ashwin has posted a right answer. Anonymous is asking me, sir, why 1 minus tax rate See, that's the formula. I can give you derivation of the formula also, but it is easy to memorize. Original formula for shortcut of KO is EBIT divided by capital employed. But here the formula is EBIT divided by capital employed multiplied by 1 minus tax rate. Simply. If you multiply it by 1 minus tax rate, you'll get after tax cost. Derivation of the formula is feasible, but it will unnecessarily eat our time. How value of debt is calculated? Oh, probably you joined the session late. Value of debt is simply amount of interest divided by rate of interest. That will give you value of debt. Okay. All right. So NI approach was saying even a slight change in amount of debt will result in change in overall cost of capital and wealth of the company. Therefore, you need to be very careful while deciding capital structure. On the other hand, the conclusion of Modigliani and Miller approach is just opposite. Modigliani and Miller approach says that whatever change you make in capital structure, you double the amount of debt, you reduce the amount of debt to the half of the level, you eliminate debt, whatever capital structure changes are made, overall cost of capital will remain same. Yes, you heard it right. Whatever change in debt amount you make, KO, weighted average cost of capital, will remain same, and value of the firm will also remain same. It's hard to believe this because debt is cheaper, equity is expensive. If you increase proportion of cheaper source, in that case, overall cost of capital must definitely reduce or change, better I say. But M&M is saying no, it will remain same. And to prove their approach, Modigliani and Miller actually used arbitrage process. M&M used arbitrage process to prove their approach. So arbitrage process is not given by Modigliani and Miller. They have used arbitrage process. It's a general process. Whenever there is a disequilibrium in the market, say in Indore Sarafa market, gold is trading at 53,000 rupees per 10 gram. While in Mumbai, it is 50,000 rupees per 10 gram. So this is disequilibrium in two different markets. Price of one single item is different. Mumbai is offering cheaper gold at 50,000 per 10 gram. Indore is offering expensive 53,000 rupees per 10 gram. So this disequilibrium will cause somebody to do the arbitrage. You go to Mumbai, buy gold over there at 50,000, sell it in Indore at 53,000, make profit of 3,000 rupees. So arbitrage means buying of an asset in one market at a lower price and selling it in another market at a higher price and make profit. Now, following are the characteristics of any arbitrage process. Number one, you need not to make any additional investment. Number two, you don't take any additional risk. Fantastic. It's a process where investment is not required. Wow, crazy. No investment is required. Number two, you don't have to take any risk. And number three, you still get a positive return. You are pursuing this course CM. You are making investment. You are spending a lot of money for this course. Number two, you are taking a risk also, because if you don't study properly, you may fail in the examination also. It is very much possible. And number three, still the positive return is not guaranteed. You'll get salary or job offer or practice only if you pass the examination. So you are making investment, you are taking risk and no guarantee of return, and still you are doing it. But I am talking about a process where the investment is zero, where the risk is zero and guaranteed positive return is there. If anybody get this opportunity, then definitely he would like to avail this opportunity. You need not to give him the motivation, just go and do the arbitrage. If there is arbitrage opportunity, if there is disequilibrium, people will automatically start doing the arbitrage. And once the arbitrage starts, disequilibrium is converted into equilibrium. So Mumbai market is offering gold as 50,000. Indore market is offering gold at 53,000. People will buy in Mumbai, sell in Indore. When they buy in Mumbai, price in Mumbai will slowly and gradually will go up. When they sell in Indore, due to selling pressure, price in Indore will reduce. In Mumbai, there is buying pressure, so price will rise. In Indore, there is selling pressure, so price will fall. And eventually, there will be equilibrium. So an arbitrager not only makes profit from for himself, but also converts any disequilibrium in the market into equilibrium. Arbitrage is possible in case of foreign exchange, in case of forwards, futures, options, derivative contract, portfolio management, anywhere. Whenever there is a disequilibrium, you can do arbitrage. Modigliani and Miller also use the concept of arbitrage to prove their approach. Let's take the same example which we took for NI approach. So the capital employed is 2 lakh rupees. You are earning EBIT of 30,000 on 2 lakh rupees. Your cost of equity is equal to 12.5%. One additional information is given. An investor is holding 15% shares in the levered firm. Now, what is levered firm? If you have debt in your capital structure, you're called levered. If you're purely financed by equity, you're called unlevered. Like levered firm has debt of 1 lakh rupees and equity of 1 lakh rupees. While unlevered firm has zero debt. Zero debt, it means you are unlevered. Some debt, it means you are levered. And it is purely financed by equity, which is 2 lakh rupees. So there are 3 steps to solve under the Modigliani and Miller approach. The first step will look like the steps of net income approach. When I solve first step of M&M, you will feel we are not doing M&M, we are doing NI. The step is like that only. I can't help that. So look here. Step number 1 is valuation of firms. CMA Intermediate, Financial Management, Chapter Capital Structure Theories. There are 4 approaches: NI, NOI, M&M, traditional. NI we have gone through, NOI will do later. Currently we are doing M&M. NI and M&M are opposite. NI says change capital structure and see the effect on value. M&M says even if you change capital structure drastically, there will be no effect. There will be no effect on value. There will be no effect on overall cost of capital. So to prove their approach, M&M use arbitrage process. How? Let's start with EBIT, which is 30,000 for both companies. Then I'll deduct interest in case of levered firm. 1 lakh into 10%, 10,000 is the interest. In case of unlevered firm, interest is obviously 0. No tax assumption. It is also there in case of M&M. So earning available to equity shareholders is 20,000 and 30,000. Then I'll divide it by cost of equity, which is given as 12.5% in the question. So when I divide it, I'll get amount of equity equal to value of equity equal to 1,60,000 and 2,40,000 rupees. Just check it. Is this calculation correct? And let me know if there are some calculation errors. Is this correct? 20,000 divided by 12.5% will give you market value of equity of 1,60,000, while for unlevered firm it will be 2,40,000. Then I take value of debt, which is 1 lakh and nil, to arrive at total value of the firm 2,60,000 and 2,40,000. Doesn't it look like the net income approach, which says that if you have debt in your capital structure, then the value will be higher. So debt, that is capital structure, is actually affecting your value. Step number 1 is similar to the NI approach. So actually after step number 1, we can see disequilibrium. Levered company has a value of 2,60,000, while unlevered company has a value of 2,40,000 rupees. Just a second, please. This is disequilibrium. Now, Mr. Modigliani and Mr. Miller said that you are saying that there is a disequilibrium. Levered firm is higher in value, 2,60,000. Unlevered firm is lower in value, 2,40,000. Wait, this disequilibrium is not permanent. It will cause arbitrage, and quickly, as soon as disequilibrium arrives, within a day it will be converted into equilibrium. In fact, within an hour or maybe in few seconds, disequilibrium will not survive. People will do arbitrage and it will be quickly converted into equilibrium. So what do you do in arbitrage process? You buy where the price is low and you sell where the price is high. Now these two firms are exactly same except their capital structure. These two firms are exactly same except their capital structure. So you should buy shares in the company where the value is low, that is unlevered firm. And you should sell shares in the company where the price is high, that is levered firm. So any intelligent investor will buy his shares of levered company because the firm value is higher, and with that money he will buy shares of unlevered company because its value is lower. And investor is holding 15% shares in levered firm. Investor is holding 15% shares in levered firm. Step number 2 now. Investment. Investor will sell his shares in levered firm. So look here, the levered firm, total value of its equity is 1,60,000 rupees. Total, all equity shares. But you are holding just 15% shares. 1,60,000 multiplied by 15% will give you a value of 24,000. So by selling this shares in levered firm, you'll get 24,000 rupees in your pocket. Now I should say that buy shares in unlevered company with this amount of 24,000, but I won't say that. Every investor has a risk-taking capacity. Every investor has a willingness to take risk. This concept is applicable everywhere in the life, not only in Modigliani and Miller approach. Say, if I talk about all of you, so some of you ride your two-wheeler at a very lower speed and that too in a straight line, and wearing the helmet and other safety gears also. And some of you are very rough drivers. You will ride your bike at a very high speed and you will drive zigzag, and even you will not wear the helmet. This may be the situation, right? Some people take more risk, they have that habit. If you put them in a risk-free situation, they will feel uncomfortable. And vice versa. Some people don't love to take risk. If you push them to take risk, they will become uncomfortable. So this investor who is shifting from the levered firm to the unlevered firm would like to maintain his level of leverage. Look, existing company has borrowed a sum of 1 lakh rupees. So there is a debt burden on the head of shareholders of 1 lakh rupees. This guy is holding 15% shares in the company. So out of 1 lakh rupees, he is having a debt burden of 15,000 rupees. आपकी कंपनी ने लोन लिया है तो उसका बोझ आपके सिर पर है ना बेटा. और अगर आप कंपनी के 15% के मालिक हैं तो आपके सर पर 15,000 रुपए के लोन का बर्डन है. So in this company, indirectly, you are having a loan burden of 15,000 rupees. Company has borrowed 1 lakh rupees. Your holding is 15%. So indirectly, your loan burden is 15,000. But when you switch over to the unlevered company, that company has zero debt. And you will feel absence of debt over there because you want to take risk. By borrowing money, you actually take risk. You would like to maintain your level of risk. I'm not saying you will take additional risk. You would like to maintain your level of risk. And that's why 1 lakh rupees is debt amount multiplied by 15% your shareholding in the company. You will borrow 15,000 rupees and total amount in your hand will be 39,000. And you will not invest just 24,000 in unlevered company. Rather than you will invest 39,000 rupees in unlevered company. This way, you are not only making a switchover, but also your level of financial risk is same as before. Look here, your additional investment is zero. After this switchover, your bank balance will not reduce because 24,000 you are getting by selling share, 15,000 you are borrowing, total investment 39,000. So your additional investment is zero. Your bank balance is not reducing after this step. Your additional risk is also zero. You are maintaining your level of risk as it was there in levered form. You are maintaining the same level even after switching to unlevered form. So level of risk is same, my dear. Level of investment is same. No additional investment, no additional risk. Now I just have to prove the third characteristic of arbitrage, that is additional return. No risk extra, no investment extra. Now let's talk about return. Look, before I talk about return, let me tell you one thing. That this cost of equity of 12.5%, it is cost for the company. But the same amount is income for investor. KE is cost for company, but it is income for investor. Keep in mind. Now his incremental return is as follows. Income from shares in unlevered company. He has bought share worth rupees 39,000 and KE of unlevered company is 12.5%. So on this 39,000, he will be earning 12.5% return. So that comes out to be 4,875. You can check it and tell me if the calculation is wrong. 39,000 into 12.5% will give you 4,875, right? But here you are in a borrowing position also. You have borrowed 15,000 rupees at the rate of what? Interest rate given in the question is 10%. Let's assume if the company is borrowing at 10%, investor can also borrow at 10%. So on this loan of 15,000, you'll borrow money at 10% and you'll pay interest each year of 1,500. So though you are earning 4,875 from your investment in unlevered company, but you are paying interest at 1,500 rupees. So after switchover, your net income from unlevered company is 3,375. Let's check what was your income before switchover. Your investment in levered company was 24,000 rupees. And cost of equity of levered company is 12.5%. So on 24,000, you were earning 12.5%, which is 3,000. Now, incremental income due to arbitrage. Earlier, you were earning 3,000 per annum. Now you are earning 3,375. So your extra income is 375. No extra investment, no extra risk, and still you have a positive return. I can tell you a shortcut for this calculation. Just listen carefully. Earlier, your equity investment was 24,000. Now it has gone up to 39,000 because this time you have borrowed at 15,000 rupees. So this 15,000 rupees, on this 15,000 rupees, you have invested this money in equity of unlevered company where cost of equity is 12.5%. So on this 15,000 rupees, you will invest it in equity and earn 12.5%, while the rate of interest on 15,000 is 10%. So I borrowed money from the market at the rate of 10% and I invested that money into equity shares where my earning is 12.5%. So on 15,000 rupees of loan, I'm earning 2.5%. 15,000 into 2.5% is nothing but 375. So this is the super shortcut. Don't solve the question with this shortcut in the examination. You won't get marks. This is just to check your answer. So this is the shortcut. You know, in fact, this shortcut will make you greedy. आप लालची बन जाओगे. So if I'm borrowing 15,000, then on 15,000 my extra income is 2.5%. Why don't I borrow 1 lakh rupees instead of 15,000? If you borrow more, your risk will increase. Here you are maintaining your risk. If you borrow more than 15,000, your risk will increase. And the condition of arbitrage will not be fulfilled. No extra investment, no extra return, still positive return. Moral of the story, arbitrage is happening. If arbitrage is happening, every rational investor will try to sell his holding from levered company and will try to buy unlevered company. So there will be a selling pressure on levered firm. So slowly and gradually its price will reduce. And there will be buying pressure on unlevered firms, so its price will increase and equilibrium will be established. Step 1, do the valuation of firm. This looks similar to NI approach. Step 2, shift from expensively valued company to the lower value of company and then calculate return. And there is a shortcut for calculation also. Just feel free to ask me if you have any doubts. This is Modigliani and Miller approach. I request you to take a screenshot of this. First, you take a screenshot of this, step 2 and 3. 3, 2, 1, go. Done. Now you take a screenshot of question as well as step number 1. 3, 2, 1, go. Fantastic. So now you know the whole process. Question number 8 is for your homework now. Homework means classwork. Sorry, not homework, it's the classwork. Solve question number 8 now. Maximum in 10 minutes time you should solve it. Meanwhile, I'll assist you stepwise also, don't worry. Okay, at least tell me value of HLL and HUL. $27 lakh and 32 lakh, 3,24,000 total equity. Okay. I think value of firm, levered firm is probably 36 lakhs. And value of unlevered firm is probably 32 lakh 40,000. Just check it. Hey, come on, everybody. You're doing it slow, huh? Try to do it fast. Yes, Vijit. Your answer is correct. 5,400. Yes, Ruby. Your step one answer is correct. No, it's not. 27 lakh is the value of equity. You need to add value of debt also to it. So the value of firm will be actually 36 lakh for Hindustan Lever Limited and 36 lakh, 32 lakh 40,000 for Hindustan Unilever Limited. Okay, I'll show you step number one. Step number 1 should look like this. Okay, Archana got the final answer also, which is 5,400. And that sounds good. That sounds to be correct. Okay, now I'll show you second step also. So value is 36 lakh and 32 lakh 40,000. It means that levered firm has higher value. You should sell your shares from levered firm and buy shares in unlevered firm. When you sell shares in the levered company, 27 lakh into 15% of your holding will give you 4,05,000 rupees. At the same time, you borrow money, 9 lakh rupees. 9 lakh rupees is the borrowing for the company, and you are 15% owner in the company. So you will borrow 9 lakh into 15%. That is 1,35,000. So you will buy shares in unlevered company worth rupees 5,40,000. Perfect. And the last step is like this. Income from shares in unlevered company, it is 5,40,000 into 10% cost of equity, which is 54,000. Less interest on loan, 1,35,000 you borrowed. Here you assume that if the company can borrow at 6%, I can also borrow at 6%. After switchover, your net income is 45,900. When you were part of levered company, your investment was worth 4,05,000. And on 4,05,000, at the rate of 10%, your earning was 40,500. So your incremental income due to arbitrage is 5,400. And here I can apply the shortcut also. You borrowed 1,35,000 at the rate of 6%. You invested it in equity at the rate of 10%. So your income, extra income is 4%. Borrowing is at 6%. Investment is at 10%. So 4% income on borrowing, it is 5,400. Okay. So I hope everybody got the answer now. If there is any doubt, feel free to ask. Let's do one question on reverse arbitrage. Now, what is reverse arbitrage? Look, I will copy this question here. In this question only, I'm making one change. It says that in this question, if an investor holds 10% of equity shares of Hindustan Unilever Limited, and due to high leverage, equity capitalization rate of HLL is 18%. Look here, the current equity capitalization rate is 10% for both companies. So KE for HLL and HUL is 10-10. But now question is saying the first one is 10, but the second one is not 10. Now this is 18%. An investor is holding 10% shares in HUL. So now the question is asking you, will it be beneficial for the investor to switch over to HLL from HUL to HLL as per M&M approach? Look how the solution will change now. Now here I will not divide by 10%. Here I will divide by 18%. So just help me with this calculation. It is 3,24,000 divided by 18%. So I think it should be 18 lakh rupees. No, not this one. This one, in fact. I'm sorry. It is 2,70,000 divided by 18%. So it's actually, sorry, it's specially mentioned that equity capitalization rate of HLL. So this rate is becoming 18%. Okay. So this will be 15 lakhs. And if it is 15 plus 9, will give you 24 lakhs. Now the situation is reversed. Levered company has value of 24 lakh. Unlevered company has value of 32 lakh 40,000. But the rule will remain same. Sell the expensive. So this time you will sell unlevered 32 lakh 40,000. So you will buy this company. So you will switch over from unlevered company to levered company. Because you are required to sell expensive and buy cheaper. Expensive is HUL, sell that. Cheaper is HLL, buy that. So sell shares in unlevered company. That will be 32 lakh 40,000. And you are holding 10% shares in HUL. Question is saying 10% shares of HUL. So I'll sell shares in unlevered company. That will be 3,24,000. With this amount, I'll buy shares in unlevered company. I'm sorry, in levered company. Also, I will lend money at the rate of 6%. Look, try to understand. Now you are shifting from unlevered company. I'll write the title for your convenience. This is levered. This is unlevered. Now we are shifting from unlevered company to levered company. You are shareholder of unlevered company currently. Now what does that mean? That means You don't love to take risk. You're a shareholder of unlevered company. You don't want to take risk. Now you are shifting to levered company. Levered company has taken risk by borrowing the money. So how can you neutralize that risk? You're going to a company which has borrowed money, so you personally lend money. So kind of borrowing and lending will cancel the risk of each other. You're going to a company which has made a sin of borrowing money. आप उस कंपनी में जा रहे हैं जिसने लोन लेने का पाप किया है, तो आप पर्सनली किसी को लोन देके उस पाप का प्रायश्चित कर लेंगे. You're going to a company which has borrowed money, and to compensate that, you should personally lend money. But how much money should I lend? So the answer is your lending should be in proportion of 15 lakh is to 9 lakh. So that is 5 is to 3. So 5 is to 3, buy shares in levered company. It will be like 3,24,000 into 5 by 8. I want to divide it in the ratio of 5 is to 3. So I'll do 5 by 8 and 3 by 8. So 3,24,000 multiplied by 5 divided by 8 will give me 2,02,500 rupees. And I lend money at the rate of 6%. This is also 3,24,000, but it should be multiplied by 3 by 8. So 3 by 8 portion I will not invest in equity shares. Rather than I will lend that money. So that will become 1,21,500. If I make a total, the total is 3,24,000. You know. So why we are lending money? To mitigate the risk, to reduce the risk. We are going to a company which has borrowed money, so we will lend money. So kind of the risk will be cancelled. Now, as far as returns are concerned, is income from shares in levered company will be 2,02,500 multiplied by 18%. So 202,500 into 18%. He'll be earning 36,540. If any of the calculation goes wrong, please tell me, I'll correct it. Now I'll not deduct interest, add interest on lending. So my lending of money is 1,21,500, and on 121,500 I will earn 6% interest. That is 7,290, and 7,290 plus 3,6450, 4,3740. Just take this calculation for any errors. So my net income from levered firm is 4,3740. My income, okay. My income from unlevered firm was like this. Income from unlevered firm was, my investment was 3,24,000 at the rate of 10%. So that was 32,400. Earlier I was earning 32,400. Now I'm earning 4,3740. So my excess earning is 11,340. I hope that makes sense for you and it's clear to you that how to solve in case of reverse arbitrage. You know, whether the arbitrage is a normal arbitrage or it is a reverse arbitrage, you will come to know only after solving step number 1. After solving step number 1, if the levered company value is more, it's the normal arbitrage. But if the value of unlevered company is more, then it will be reverse arbitrage. In case of normal arbitrage, you know what happens is you borrow money. But in case of reverse arbitrage, you actually lend money. Avijit is asking, sir, please explain with tax. Avijit, actually, Modiglani and Miller approach is never solved with tax. Though they call it M&M with tax, but actually that is net operating income approach with tax. So M&M with tax is nothing but NOI with tax. NOI I will try to solve just after this example. Okay. I'll give you example for with tax also, but the steps will not be like this. With tax, it will be like NOI approach. So 554,000 interest, how it comes in step number 1. See, you have borrowed 9 lakh rupees, your company, and 6% is the rate of interest. So 9 lakh into 6% is 54,000. Okay. So Abhijit has asked me to show Modiglani and Miller approach with income tax. Definitely, I'll show that to you. But better, I will name that as net operating income approach with income tax. This is the question. You can also call it, instead of NOI, you can also call it M&M with tax. NOI I have not discussed so far, but definitely I can discuss this question with you. Companies U and L are identical in every respect, except that the former does not use any debt in its capital structure. So U is a levered company, L is levered company. Look, though we are calling it M&M with tax, but none of the steps of M&M with tax are similar to an M&M without tax. It is entirely different approach, totally, altogether different. So I personally prefer to call it net operating income approach with income tax. U is unlevered company, L is levered company, and L has borrowed 6 lakh rupees at the rate of 15% per annum interest. U doesn't have any loan, L has a loan of 6 lakh rupees at 15% per annum. Assuming all NOI assumptions are met, corporate tax is 50% now. EBIT is 2 lakh rupees. And the equity capitalization rate of unlevered company is 20%. What will be the value of firm UNL? Also determine the cost of equity of both firms. Look, there are two firms, unlevered and levered. Both have EBIT of 2 lakh and 2 lakh. Unlevered has zero debt. Levered has debt of 6 lakh at the rate of 15%. Cost of equity of unlevered company is 20%. You know, if I arrange this information in the form of a table, then probably your understanding will be better. This is company U, this is company L. So amount of debt at the rate of 15% is 0 and it is 6 lakh. Then EBIT is 2 lakh and 2 lakh. And then cost of equity is given as 20%, and here it is not given. And you have to calculate value of both the firms, and you have to make some other calculations also. Okay, this is the situation. So now, solution for this situation: tax rate is 50%. There are fixed formulas to solve this situation. First of all, value of unlevered firm is EBIT multiplied by 1 minus tax rate divided by cost of equity. You know, in case of unlevered firm, there is no interest. So EBIT minus multiplied by 1 minus tax rate will directly give you earning available to equity shareholders. EBIT, no interest, multiplied by 1 minus tax rate will give you earning available to equity shareholder. Divided by cost of equity, you will get market value of equity. There is no debt, so market value of equity and market value of firm are one and same thing. So value of unlevered firm can be calculated like this. EBIT is 2 lakh. 1 minus tax rate will be 0.5. Cost of equity is 20%. So value of unlevered firm is 5 lakh. This is logical. This is very much same as the NI approach. If I solve this question NI with tax, the value of unlevered firm will be same, 5 lakh. But M&M or NOI with tax, whatever you want to name it, The next formula is very important. M was saying that value of levered and value of unlevered firm must remain same with an assumption that there is no corporate tax. But if there is income tax, then M&M approach changes its conclusion and it says that no, now both the firms will not have the same value. Levered firm will have more value. And you know why and how much more value? Value of levered firm is equal to value of unlevered firm. Without tax, VL and VU were same. VL is equal to VU, but with tax, it will become plus debt, amount of debt multiplied by tax rate. So here value of unlevered firm is 5 lakh as calculated in the above step, plus loan amount is 6 lakh multiplied by tax rate. It's not 1 minus tax rate, it's the tax rate is 0.5. So that will be 5 lakh plus 3 lakh. So value of levered firm is 8 lakh. Now the M&M conclusion changed. Now M&M is not saying value will remain same. Now it is saying levered firm will have higher value. And higher the amount of debt, higher the value of the levered firm, because it is debt into tax rate is to be added. Now, if somebody tell you to calculate overall cost of capital for levered firm, the formula is same as what we studied in NI approach. EBIT multiplied by 1 minus tax rate divided by overall cost gives you value. So divided by value will give you KO. In NI approach, we use this formula like, okay, we used it this way only. KO is equal to EBIT into 1 minus T upon value. So for levered firm, EBIT is 2 lakh. 1 minus tax rate is 0.5 divided by value 8 lakh. See, its KO is 12.5. I must tell you one more thing over here, that if I calculate KO also, then for unlevered firm, KE and KO remains same. But for levered firm, now we calculated it to be 12.5%. So, buddy, you wanted me to calculate M&M with tax. Here it is. But sir, it doesn't look like M&M anymore. Yes, that is how it is done. Check this and ask me if you have any doubts. Okay. So now you know NI with tax without tax. Now you know M&M with tax without tax. And now you know NOI with tax also. The only thing left now is NOI without income tax. So I'll quickly give you one example because now the time is getting over. NOI. Okay, rather than going through example, now I'm giving you net operating income approach with an assumption that there is no corporate tax. What does it say? That KD is constant with increase in amount of debt. Mind it, now I'm talking without income tax, I'm talking net operating income approach. With increase in debt equity ratio, KD will remain constant. This is one assumption. But a more important assumption is here. With increase in debt equity ratio, cost of equity also increases. And look, this is logical. Why this is logical? Because when you borrow money, your financial risk increases. If risk increases, expectation of equity shareholders also increases. So more the amount of debt, more the cost of equity. On one hand, by increasing debt in your capital structure, you are getting advantage of cheaper debt. But on other hand, this advantage of cheaper debt is compensated by equity getting expensive. By borrowing money, you're increasing risk. By increasing risk, equity shareholders' expectation will rise. So this advantage of cheaper debt will be exactly compensated by equity getting expensive, and that way overall cost of capital will remain constant. So even if you keep increasing borrowing, increase borrowing further, overall cost of capital will remain same, and that's why value will also remain same. So this is net operating income approach without income tax. And now the last approach, for which we won't be able to solve question. But anyways, it's simple also. You know, NI says slight change in capital structure will affect value. NOI says any change in capital structure will not affect value. M&M says any change in capital structure will not affect value. अभी income tax को हम side में कर देते हैं. Let's assume there is no income tax to make our life simple. NI says yes, it affects. NOI says no, it doesn't affect. M&M says no, it doesn't affect at all. So these are two reverse direction approaches, east and west. Exactly reverse. And both are theoretical in real life. In real life, the best suitable approach is traditional approach. It says that up to optimum level of debt, KD remains constant and then it starts increasing. Up to optimum level of debt, KE remains constant and thereafter it also increases. Therefore, up to optimum level of debt, when both KD and KE are constant and debt is increasing, cheaper sources increasing, so KO keeps on reducing and come at the minimum level. And then KD and KE both rises, so KO also rises. So NI was saying borrow highest amount and take advantage. NOI, M&M were saying whatever amount you borrow, it hardly matters. Traditional approach is saying borrow, but only up to optimum level. Borrow only up to optimum level. What is optimum level? Where KO is minimum. Below optimum level of debt, KO will be more. Above optimum level of debt, KO will be more. At optimum level of debt, KO will be minimum. All right. So with this, I'm ending session for the day. If at all any further session is scheduled, then ICMAI will intimate you and then we will study further. Till then, bye-bye. Good night. Hope to see you again.